This is an uncovered Japan company research report on CELM, ticker 7367. CELM is a small Japanese consultancy with a surprisingly deep seat inside corporate Japan. It helps companies build leadership pipelines and tackle organizational challenges using an asset-light network of external professionals. In this video, we will look at the business, the financial signal, the shareholder return case, and the execution questions that frame the valuation. At the report date, CELM traded at 11.7 times forward earnings, near the low end of its 5-year range. The company also offered a 4.77% dividend yield and reported a 20.6% return on equity in fiscal 2026. Those figures are appealing, but they need context. The market is discounting a deliberately flat near-term profit outlook and the risks that come with a small, thinly traded company. Here is the model in plain English. A corporate client brings CELM an issue such as succession, executive development, culture change, or management training. CELM's own team scopes the work and matches it with the right facilitators, coaches, and specialists from a network of more than 1,600 outside professionals. Only around 600 are active at any one time, so specialist delivery costs flex with the project load. That is why this small services company can sustain gross margins around 50%. The reported growth record is solid. Revenue rose from 6.47 billion yen in fiscal 2022 to 10.31 billion yen in fiscal 2026, a 4-year compound annual growth rate of 12.4%. Operating profit also grew from 730 million yen to 1.16 billion yen. The jump in fiscal 2026 included the first full-year contribution from KYT, the interpreting business CELM acquired, so the top line is stronger than the near-term margin picture alone suggests. The segment split explains the key operating tension. The historic organizational and HR development segment generated 76.2% of fiscal 2026 sales and a 20.1% segment margin. The newer stakeholder relations business, known as KYT, added almost a quarter of sales but earned only a 5.5% margin. The opportunity is to improve KYT and cross-sell into CELM's blue-chip customer base. Until that happens, the lower margin acquisition dilutes the group mix. Cash generation is the quieter strength. Operating cash flow was 1.06 billion yen in fiscal 2025 and 1.03 billion yen in fiscal 2026. Excluding acquisition spending, underlying free cash flow was about 1 billion yen in both years. The model needs little inventory and little capital expenditure. That recurring cash has funded dividends, buybacks, and debt repayment, while keeping a cash buffer for future investment or acquisitions. The most important near-term issue is fiscal 2027 guidance. Revenue up only 0.6% and operating profit down 5.3%. Management says that dip is deliberate. It is front-loading an AI and digital transformation overhaul while building toward a 2 billion yen operating profit target for fiscal 2029. The plan relies on deeper spending by core clients, productivity gains, disciplined M&A, and margin repair at KYT. That makes the pause an investment choice, but it still has to work. CELM's balance sheet is healthy, but it is not risk-free. The equity ratio recovered to 42% in fiscal 2026 after acquisition-funded borrowing, and net debt to EBITDA was only 0.21 times. Return on equity stayed near 20%. The important caution is goodwill. 3.14 billion yen, or 44.5% of total assets, reflects the acquired businesses. A serious deterioration at KYT or HSJ could create an impairment charge, so operating profit, EBITDA, and cash flow are more useful than any single net income number. CELM's capital return profile is unusually strong for its peer group. Its forward dividend yield of 4.77% is well above Lincoln Motivation at 2.82%, and roughly double the service sector average. The company has formalized a progressive dividend policy and authorized a 200 million yen buyback at the start of fiscal 2027. That yield helps defend the valuation, although it should not distract from the execution work required to lift profits. The valuation case begins with the D rating. CELM's forward PE peaked near 19 times after listing and had fallen to 11.7 times at the report date, against a 5-year average around 14.6 times. The company traded roughly 40 to 50% below its listed comparable and the service sector range. The discount has clear explanations. A 7.5 billion yen market cap, thin liquidity, flat fiscal 2027 guidance, and a shareholder base still adjusting after the stock split. The report's scenarios make the dependency explicit. Starting from a reference price of 326 yen, the author's fiscal 2029 range runs from 540 yen in the bear case to 1,310 yen in the bull case, with an 880 base case. These are illustrative calculations, not forecasts or price targets. The base case assumes CELM reaches its 2 billion yen operating profit goal, and the multiple recovers toward its historical average. The bear case still requires the business to keep generating cash, while the bull case needs both operational delivery and a meaningful re-rating. CELM combines a differentiated asset-light model, high customer trust, steady cash generation, and a high dividend yield with a valuation near a 5-year low. The trade-off is equally clear. Its fiscal 2029 ambition depends on AI and digital productivity, better KYT margins, and execution through a CEO transition. While goodwill and liquidity remain real risks, this is not investment advice. It is a concise map of the evidence and the milestones that matter. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security.